Shell doubled down yesterday, denying rumours it's in early talks to take over rival UK energy giant BP. It's not the first time BP has been subject of takeover speculation. A shaky strategy reset, declining annual profits, and the departure of the CEO, the then CEO, Bernard Looney, and continued underperformance of its share price versus its peers has raised fresh questions about BP's strategy. Current BP Chief Executive Murray Auchincloss has set a course to restoring his company's status, from improved cash flows to ambitious capital spending. Our next guest sees a takeover as unlikely, saying buying BP would not leave Shell better off, but that it could be the best thing BP's board could do for its shareholders. Alan Good is Senior Equity Analyst at Morningstar. Alan, fascinating situation as well. Look, I've looked at BP and interviewed every CEO a lot for a quarter of a century. Is BP as bad as the detractors are saying at the moment? As far as I can see they've got some extraordinary upstream assets still. They've got some great businesses as well. Amongst other things, like the rest of the majors, they just need more cash flow, better return on average capital employed, both of which Murray Auchincloss has promised as well, and, dare I say, a higher oil price.
Yeah, higher oil prices can solve all problems a lot of times for oil and gas majors, but it tends to be temporary. I think the problem with BP is, they had a strategic pivot earlier this year. What they announced was probably what investors were mostly looking for: cost cuts, a refocus on returns, less investment overall, less investment in low carbon. But frankly, it's about 2 years too late. They and Shell both pivoted towards more of an integrated energy company, more of a low carbon type model in 2020, cut the dividend. But Shell was quicker to realize that that model was not working, that oil demand was not going to decline like they thought, and they pivoted back with their new CEO a couple of years ago. BP continued to hold on to that line that they were going to be an integrated energy company, that low carbon was the way to go. And over that extra 2 years, returns continue to suffer, costs continue to grow, and earnings continue to fall. So I think there's a case here where BP may have the right plan. It may even have some good assets. But I think it's lost some investor trust in the sense of making that pivot in 2020 and then waiting even longer to pivot back towards oil and gas. And so now it's at a case where, if you look at them at a relative level across global integrated, especially compared to Exxon and Chevron, but even to European peers like Total or Shell, they just are a less compelling investment, even if they're doing the right things. And so I think that's left them in a position where they just don't have the investment case that some of their peers do, and that's left the stock struggling over the past couple of years.
So why, just going back to the original point in the introduction, why is this not a right takeover target for not just Shell, but Exxon potentially, or ADNOC potentially, and then obviously any of those three companies could potentially sell off the assets they don't like, but they would buy obviously all the upstream exposure that it already has, and then obviously be able to take out even more management costs by integrating it into their businesses. Why is it not a good fit for someone?
Well, if you look at Shell specifically, it's unclear that that solves any of the issues that management is currently trying to resolve. Shell's plan is really to reduce costs, reduce spending, ultimately improve returns, and then close the valuation gap with Exxon and Chevron. If you just buy BP, and I'll caveat this by saying valuation is probably the biggest driver here, then yeah, you can reduce costs some more. You can maybe perhaps sell off assets that BP wouldn't otherwise do. And in that case, yeah, maybe it does make sense. But again, it goes back to the valuation. But when you do a mega merger like that, it does ultimately add a lot of work. There's going to be culture clashes. There's going to be political headwinds. And I think at the end of the day, it may just prove to be a distraction to Shell, who frankly is executing on their plan. It's working. They haven't completely closed the valuation gap. But it is trending in the right direction. So for them to do a mega deal where the valuation is going to be in question, where the value just isn't clear. If you look at Shell and wonder, hey, what's missing here? It's really sort of a strong asset that can deliver oil growth. BP doesn't necessarily have that either. Yes, they get BP's Permian position, which is growing about 7% per year, but it is still relatively small. So I
Right.
think from Shell's perspective, again, unless the valuation is super attractive,
Yeah.
then it's probably not worth the headache of going through the political headwinds, trying to get the regulatory approval, selling it to shareholders, selling off the assets, which is going to be a multi-year process, instead of just sticking with their current plan. Now,
Right.
if you're talking
Alan?
about an asset breakup and asset sales, yeah, maybe ADNOC is involved in that case, and you start to sell off assets. But then the question becomes, what's going to be remaining of BP, and what's the point?